All right, we got a lot to cover, so we'll jump into it. I'm Glenn Suchfield, VP of Marketing for DMI, and we're here to introduce an important shift in how retirement income planning is approached. So today we'll be focusing on why the traditional strategies so many advisors rely on are no longer enough, and how the CSSCS framework offers a more efficient, more effective path forward. We'll also introduce our new retirement asset optimization software, which is a really powerful tool built to reflect the optimization principles that we're going to be covering today. While we won't dive into the software itself, you'll see a sample output at the end to show how the strategy comes together in practice. But at the heart of today's session is just a simple but critical truth. When you focus on income, not just growth, you can often deliver fully funded retirement plans with half the capital. So that's the power of optimization and why this strategy is changing the game for advisors and their clients alike. And as always, it'd be impossible to do this without him, we've got Andy Robertson, our good friend at CSSCS. He's the head of business development and training for CSSCS. And then, of course, we also have our very own Eric Lindewall, with over 20 years experience as an annuity wholesaler and very well versed on CSSCS and all the strategies, tactics, and techniques behind it. So with that, guys, everybody viewing today, please take part in this as much as possible by using the Q&A function. So depending upon the question, we may integrate it into the presentation, or we may save most of those questions for the end, but we will get to it. So thanks for being here. Really appreciate your attendance. And Eric, I'll hand it off to you and let you say a few words.
I appreciate that, Glenn, and good morning or afternoon to everyone. Thank you for joining us today. We're excited to have an opportunity to share a little bit of time with you to talk about a topic that we think could potentially have a tremendous impact on your business. I'm a VP of annuity sales here at DMI, so I talk with advisors all over the country, helping them with solutions for all of their clients' problems. One consistent theme that we hear all the time is, as folks are transitioning towards retirement, is it all going to work? And, we spend our entire lives focused on accumulation and oftentimes accumulate a fair pile of assets. And as we look forward towards retirement, we wonder, have we done enough and will it work? And the industry has a lot of tools that, purport to analyze that and give you a sense of whether your plan will work or not. But I can tell you and Glenn was very kind. I've actually been in the industry for 30 years. In my 30 years in the industry, I've not seen a solution that more clearly articulates whether or not a client's situation has any potential problems with it, and then also clearly articulates actionable things that can be done to solve the problem. Let me give you an example. I might be getting ready to retire, looking forward, and I've got a mental plan of what I think I'm going to do. I'm going to take my Social Security at 62, and I've got a pile of money, and this is how much income I need, and I think it's going to work out. The tool or the concepts that we're going to go over today, and then ultimately the tool that's available through CSSCS will help you sit down with a client and identify whether or not their current strategy will work. And oftentimes the math says it won't, but then it will very clearly illustrate to them that by just making and oftentimes one key planning change and one key allocation change, they can go from underfunded in retirement to overfunded. And it is a remarkable process and program that really identifies a potential issue and then shows a client how to solve it while not making any changes to their hopes, goals, and dreams in retirement. So it's a powerful, powerful, powerful solution that the advisors that embrace it find helps deepen relationships with clients and helps them write more business. So with that, Glenn, I'll turn it back to you, or actually, I guess, turn it back to Andy to dive in.
Great. Thanks, Eric. Thanks for the introduction, and good morning, everybody, or afternoon, I guess, depending on where you are. My goal here in the time we have together is to get you just to think a little differently maybe than you have before about retirement income planning, and specifically how you can leverage all the tools in the retirement planning toolbox. So I think we all have a tendency to avoid some of the tools that are available to us because of the complexity. And of course, we don't want to get caught and cornered by questions that we don't know the answers to. My goal today is to show you how, by leveraging all the tools in the toolbox, you can build a better, more fortified plan for half as much capital and thereby address the single biggest concern Americans have, which is the fear of running out of money. Hopefully, that in of itself will provide the motivation you need to really take another look at some of these tools that, again, I think most people are kind of dismissing or overlooking. But this is the why. Today's about the why you want to consider all this. So, as Glenn said, I'm the co-founder and vice president of the Corporation for Social Security Claiming Strategies. What we do is we focus on educating financial advisors, and financial advisors alone. We don't deal with the public on the intricacies of Social Security, and specifically why we believe Social Security is the most dynamic tool, as I said earlier, in the retirement income planning toolbox. So we'll have about 40 minutes or so here this morning. We'll go through this. And my goal is to make you far more dangerous than you were when you showed up and inspire you to want to learn more. So hopefully I can accomplish that in the time we have together. Here's the thing I want to focus on. So right now, and you've all seen this, right? According to the academics, the vast majority of Americans, this is just one example of the statistics we continuously see, are not on pace to meet their retirement savings targets. So this is from the National Institute of Retirement Security. They haven't updated this. They were doing it every few years. They haven't updated it since 2018. Maybe COVID has something to do with that. I don't know. But here's the bottom line. This is a statistic that you're all familiar with. 77% of Americans are not on pace to meet their retirement savings targets. Put another way, 77% of Americans are going to be underfunded. The thing that no one's talking about is virtually all of the academic research that's been conducted that gives us this result assumes everyone will take Social Security benefits early. And for good reason. Statistically speaking, that's what people have historically done. But that doesn't mean that's what they should do. And what we've developed is not only a training program for financial advisors, but tools you can use and in real time show a client how taking Social Security benefits at different times can 100% change the outcome for them. It'll have a material impact on which side of the equation they end up on, the winning side or the losing side. And more often than not, they have no understanding of how Social Security truly works and the impact it can have on their overall capital requirement. And when they see it, not only is it a game changer for them, but it's a game changer for you because, as I said, no one else is talking about this stuff for a whole host of reasons. But my job is to get you to see why you definitely want to talk about it. Now, again, statistically speaking, when does everybody take? These statistics support what we already know. Most people are prone and predisposed to taking benefits early. But the real question is why. When we ask people, why do you intend to take Social Security benefits early? We get a bunch of different answers, but it can be boiled down to a couple of things. One, they think Social Security won't be here, or two, they think they won't be there. And more often than not, when push comes to shove, what they ultimately will dig their heels in on is this idea that I don't want to wait. I know if I wait, I can get more. Maybe I don't know how much more. I know if I wait, I get more. But my concern is, I may not live till 70, right? So what I hear people saying when they say that to me, when it comes to Social Security, is they don't want to make the wrong bet, right? And the wrong bet in their mind when it comes to Social Security would be opting not to take benefits as early as possible, 62, waiting all the way till 70, and on their 364th day of their 69th year, slip and fall off a 1,000-foot cliff and die with the thought that they left all that money on the table because they didn't take benefits early, right? That's what they live in fear of. That would be the wrong bet. Nobody wants to make the wrong bet. So what do? Well, the first thing they do is they buy into taking benefits early. The second thing they do is they start thinking about what I refer to as a hedging strategy. Now, before I get into the hedging strategy, I just want to talk about Social Security benefits and the impact of taking benefits early versus later. So the people you're talking to today, by and large, are going to have a full retirement age of 67. And what this chart shows you, we call it the lifespan of a PIA. It shows you what happens to your primary insurance amount, which is your retirement income benefit at full retirement age. It shows you what happens if you take benefits prior to attaining full retirement age. and what happens if you take benefits after full retirement age. So in a nutshell, what happens is for every month you take prior to attaining full retirement age, your benefit amount is reduced by a fraction. So it's a fractional reduction for every month you take early. What is that total on an annual basis? If you take it 66 rather than 67, it's a minus 6.7, 65, 13.3, so on and so forth. Ultimately, what we're looking at is if you take as early as possible with an FRA of 67, the permanent reduction is 30%. If you delay, you get a fractional increase for every month you delay, which equates to 8% per year. That's a simple interest calculation because delayed retirement credits are not applied to your benefit until you file, so there is no opportunity for compounding. But people take early because, for all the reasons I said earlier, they think they won't be here, Social Security won't be here. What they don't know and they haven't put together is what is the difference between what I can collect under current Social Security formulas, what I can collect at 62, and what I could collect at 70. And that's 77%. So to be clear, under current Social Security formulas, if you opt not to take it 62, you have an FRA of 67, and you opt to wait all the way until 70, the minimum increase you will see in your benefit is 77%. It cannot be less, but it could be more. The reason I think it's critical that we all understand what the difference is because I know what people are predisposed to do is not only take early, but as I said a moment ago, move forward with what I call a hedging strategy. And that hedging strategy is I'm going to take benefits early. I'm going to keep working. I'm going to save every check. I'm going to build a secondary retirement account with those Social Security checks that I am collecting so that if I'm still here at 70, I can use this secondary retirement account to match the 77% increase I would have gotten from Social Security had I waited. And God forbid I slip and fall off that cliff, I can die with the comfort that I never left a single check on the table because I did take at 62. Like a lot of things in financial planning, that sounds really good in theory, but the first challenge you're going to be up against, if that's your approach and you want to use this hedging strategy, is what's known as the earnings test, right? So the earnings test for 2025 simply says if I have earned income in excess of $23,400 and I am under full retirement age and actively collecting a Social Security benefit, I'm going to be subject to the earnings test. For every $2 I'm over this threshold, this $23,400 threshold, I'm going to be forced to forfeit $1 in Social Security benefits. Why is this important? Think about it this way. Let's say you have a client that earns $71,400 gross earnings. That puts them over the threshold of $23,400 by $48,000. We know for every $2 you're over the threshold, you forfeit $1 in benefits. So if I'm over the threshold by $48,000, divided by 2, I'm going to forfeit $24,000 in Social Security benefits, right? Every year between, these are my numbers, between age 62 and 66. So $96,000 of Social Security income that I was counting on to make my hedging strategy a success, I never get my hands on because of the earnings test and the forfeiture requirements imposed by Social Security because I'm over the threshold. And one important note, I said gross because that's the reality. So some people are confused about how this works. The fact that you're stacking money away using the catch-up provision in an employer-sponsored plan, so you're bringing your total taxable income down dramatically, does not help you. They're going to look at your gross earnings, and that's the benchmark they're going to, or that's the income value they're going to apply the benchmark to. So 71.4 is 48,000 over 23.4. You're forfeiting $24,000 in checks. Going to be pretty difficult to execute this hedging strategy of taking all the checks and building a secondary retirement account if you never get your hands on the checks. So through education, we help people understand why maybe if their goal is to take benefits early and keep working, things aren't going to work out quite the way they thought, right? That, as I said earlier, things in financial planning, as is always the case, are very different in practice than they are in theory. But here's the other thing I want you to think about. Let's assume the earnings test didn't exist. And let's assume that somebody had the intestinal fortitude to save every check and they wanted to truly understand what will I have to earn in the markets to build a big enough pile of cash by the time I'm 70 to match that 77% increase. And to do that justice, I'm going to assume we have a married couple, and spouse one has a primary insurance amount of $3,200, and spouse two has a primary insurance amount of $2,800. So together, if they wait till that Friday, they'll have $6,000, but they're contemplating taking benefits as early as 62. So they have that reduction, they'd get $4,200. What they want to understand is, if I take benefits at 62, and again, we're pretending the earnings test didn't exist, I save $4,200 a month like clockwork. What do I have to earn above and beyond what I save in a return to build a big enough pile of cash to have any reasonable probability I can match the 77% increase I would have gotten had I simply waited? Well, to answer that question, we need to put numbers to this, right? So I know I'm going to get 4,200 at 62. If I wait till 70, I'm going to get 7,440 or 77% more. So I need a big enough pile of cash that when added to the 4,200 I began collecting at 62 is going to get me to the 7,440 I would have gotten had I simply waited. So I am, as a result, matching what I would have gotten had I waited. So what am I saying? I'm saying that $4,200 you save like clockwork from 62 to 70 has to be worth enough to deliver $3,240 a month to go along with the 4,200, right? Now, $3,240 a month, to be clear, is $38,880 a year. It's a big number. I think we all have done enough work with financial planning and income planning specifically to know you have to have a pretty big pile of cash to deliver $38,880 in total income annually with a reasonable probability of success. We need a big number. To tell people exactly what we think that number would be, I fall back on what I'll call a credible process. You would know it as the initial, or what Bengen called the safe max, right? The initial safe max. What can you take, right, for the next 30 years, increase it to combat inflation, and have an 80% chance 30 years from now you have enough money to make that final payment? So Bengen did the initial safe withdrawal rate research. He's the first one to publish. It was a great piece of work. 4% is the initial safe max number that's been thrown around now for the better part of 30 years. Couple things about this number. One, I'm going to use it to back into how much capital I'm going to have to accumulate to deliver that additional income. But before I do that, I need to make a couple adjustments to this 4% number. So the first thing about the 4% number is it was a gross number. So the 4% number that Bengen provided, that was the maximum amount of pressure the portfolio could withstand, inclusive of fees. So we've got to get to a net number to back into how much capital we actually have to accumulate. So two things I'm going to use to make an adjustment to this 4% number. One is the fee. Two is the desired probability of success. So what Bengen sought to achieve, an 80% probability of success. Through our software, we've been able to ascertain that no one, when given the choice, picks 80%. So what am I saying? When we ask retail financial clients, retiring clients, what is the desired probability of success you seek in the development of this retirement income plan? And you can pick anywhere from 50% to 99%. No one, thousands of samples to draw from, no one picks 80. Clients pick between 90 and 99 and predominantly 99%. So being that this number, 4% number, was meant to achieve an 80% probability of success, we need to make an adjustment to it to account for the level of success that people are actually looking for, which is 99%. So in order to do that, drive it up to 99%, I'm going to take the initial safe withdrawal rate down to 3.4, and then I'm going to take some fees off the top. So in essence, what we get to is a net in your pocket initial safe withdrawal rate of 2.62%. And this is important because for me to figure out how much capital I'm going to have to accumulate by the time I'm 70, I need to get to the net in your pocket initial safe withdrawal rate so that I can back into the capital requirement. So if I need enough to deliver 38,880 8 years from now, and what I can take initially safely net 2.62%, $38,880 is 2.62% of just shy of $1.5 million. So the real question is, what do I have to earn in the market to accumulate $1.48 million in 8 years? Well, you can do the math. 4,200 times 96 doesn't get you anywhere near $1.48 million. So what's going to get you the rest of the way there after you saved every check like clockwork, assuming the earnings test didn't exist or didn't impact you? market returns. And what type of market returns would you have to have? Just shy of 34% in the compound annual growth rate, and you'll have the 1.48 million you need to match the 77% increase you would have gotten had you simply waited. So just so I'm clear, think about the positioning of the assets you'd have to be able to undertake in order to have any chance at delivering that kind of performance. I would argue that's a level of aggression that would never be allowed by any compliance department based upon the age of the people we're talking about, the objective, number one. But number two, if you were lucky enough to get the 34% compound annual growth rate, and that's all you'd be, what would you have succeeded in doing? Simply matching what you were guaranteed to get had you waited. So the reward is not there, right? The risk and reward is not there. The level of risk you'd have to take on to generate the kind of results we'd have to get does not present a reward that makes any of it worthwhile or justified. So, in addition to the fact that your income will grow by a minimum 77%, and I said that a couple of times, right? 77% is the minimum increase. It cannot be less, but it could be more. The question everybody wants to know is, how could it be more? I'm not collecting benefits between 62 and 70. That's correct. You do not have to be collecting benefits for a cost of living adjustment to impact your benefit calculation. So once you attain the first year of entitlement, age 62, whether you're collecting or not, every year that a cost of living adjustment is declared, your primary insurance amount is increased on a compounded basis to account for that cost of living adjustment. So what I'm saying is this: the only way you would have just a 77% increase is if for the first time in the history of COLAs, the Social Security Administration did not declare a single COLA in any year between the time you attained age 62 and the time you attained age 70. It's never happened. There's only been 3 times since COLAs have become automatic that the COLA was a 0, and only 1 time it was in 2 consecutive years. That's the only way, though, you would have just 77%. If not a single COLA was declared between the time you attained age 62 and the time you attained age 70. So what could the actual increase be? Every year I look back, I go back to the prior cycle and say, if I attained age 70 on January 1st, 2025, what would the actual increase have been? I knew at 62, I was going to get at least a 77% increase. Once I arrived at 70, what was the actual increase? Well, here are the cost of living adjustments that were declared for each of these years, and the increase, right, to your primary insurance amount, coupled with the 24% increase you'll get at the time you file in delayed retirement credits, didn't deliver a 77% increase. It delivered a 133% increase. So to be clear, we needed to earn 34% in a compound annual growth rate to match a 77% increase. I think we can all agree that's highly unlikely. What are the chances you're gonna match a 133% increase? I think you can all answer that question for yourselves. Beyond that, I just want to be clear. I'm not cherry picking here. This happens to be the last cycle. So in January of this year, I'll update these numbers. I'll add 26 and I'll go back to 2018. And wherever they fall, they fall. But the bottom line is this was the actual increase for people who chose to wait and not take benefits as early as 62. Now, one quick caveat here. What you're going to find is it sounds like I'm suggesting everybody should wait till 70. I'm not saying that at all. What I am doing, however, is opening your eyes to the opportunity costs, right, that exist when you don't wait till 70. Pretty much everybody you talk to can tell you why they think they should take it 62, right? They can all do, 3, 4, 5 minutes on why that's a good idea. But they are not informed as to what they're leaving on the table. So showing them the other end of the spectrum, from my perspective, has been very valuable in getting them to listen and consider alternatives to what they're already predisposed to do. Now, here's where the software really comes into play. What we do with the software is we put you in a position that before anybody makes any decisions about when and how they should take Social Security benefits, with just a handful of inputs, we can project how much capital it's going to take to meet their plan objectives if they take benefits at this age, and then conversely, if they take benefits at that age. So I refer to this software as the Waze of retirement income planning. So we had MapQuest, then we had GPS, now we have Waze. I'm sure you all are familiar with Waze. Waze, the attraction of Waze is not only will they tell you how to go, not only will they display it on a screen, but they'll also route you around all the hazards that are out there that you otherwise wouldn't have known during the days of MapQuest or even GPS. Well, this is the same idea. So the Retirement Asset Optimizer is designed to let you see every potential road you could go down and understand what's around the bend before you ever commit to traveling down that road. So that's why I say it's the Ways of retirement income planning. And I'm going to walk you through a simple example of how, through the assessment we do, we can help people make better, more informed decisions about which way they want to go when it comes to choosing their Social Security filing strategy. So let's say we have a couple. They're both currently 65. They plan to retire at 67. They have a $108,000 household pre-tax retirement income goal. They have a time horizon, meaning they want the plan for that to last for 30 years. And they have a desired probability of success of 99%. Together, they've accumulated $1.2 million in retirement assets. And again, same fact pattern as it relates to Social Security. Spouse one has a PIA of 3,200. Spouse two has a PIA of 2,800. My experience informs me that once people understand the earnings test exists, they think very differently about taking benefits at 62. Most people don't have enough money to retire at 67. So the idea that they're going to take benefits at 62 and truly retire is kind of preposterous for most people. What they're really intending to do, as I said, is take benefits early and keep working. Well, once they understand that they're going to be faced with the earnings test, that discussion goes out the window. Now we're talking about, all right, well, how much capital do I need if I want to take benefits at 67? And then conversely, we look at 70. So we answer that question by doing a very simple quantitative analysis, right? We know together they have $6,000 a month or $72,000 a year. So we're going to deduct that $72,000 from their goal and look at whether or not they have enough capital to deliver the balance of the income need. And then conversely, we're going to show what if they wait. So we're going to call the first scenario of taking benefits at 67 the earlies, and we're going to call the second scenario of waiting till 70 the laters. And to be clear, the laters are going to have at least 24% more, right? It could be more. Why is it 24%, not 77? Again, 77 is the difference between age 62 and 70. The difference between what you collect at 67 and 70 is 24%. But that's a minimum increase as well. Cannot be less, and it could be more. How could it be more? Well, it'd be more if there are any COLAs declared. But the bottom line is we're going to compare and contrast these two scenarios and see what kind of an impact taking benefits at different times can have on the number one concern people have, which is the threat of running out of money. And how do we do that? By looking at the capital. Philosophically, what we believe is if the number one concern the people we work with have is waking up penniless in retirement, then the best thing we can do is, before we give them any advice, figure out and stress test every possible option and figure out which plan is going to require them to commit the least amount of capital. Obviously, the least capital we have to commit means the greater likelihood our plan is successful. So 72,000 is what they'll have together at 67, and they'll have over 89,000 at 70 thanks to DRCs. So to really understand how taking benefits at different times impacts the capital requirement, we first have to identify the income gap. So it's 36,000 if they take early and 18,720 if they take later. Now, for the earlies, if they retire at 67 and take benefits at 67, they need their 1.2 million to deliver $36,000 to make them whole, to make their plan a success. To determine how much capital they actually need, we're going to use the same approach we used before. We're going to use initial safe withdrawal rates, net initial safe withdrawal rates. The only difference now is the initial safe withdrawal rate here is 2.4 rather than 2.62, but that's because we're taking benefits 3 years earlier, right? We're saying we're going to take it 67. So the earlier we take, the longer we expect to have that income sustained. So it's going to have an impact on the initial safe withdrawal rate. But $36,000 is 2.4% of what number? $1.5 million. Now we know they don't have 1.5, they have 1.2. Now historically, what are the options, right? There are a number of options the client could consider. They could delay retirement. They could save more money. They could reduce their income expectations in retirement. They could become more aggressive with the way they position their assets, right? Or they could do what most do, which is roll the dice and hope the market performs in a way it hasn't for the last 25 years. And that's normally what people do. Now, ultimately, the academics say the vast majority of Americans, 77%, are not on pace to meet their retirement savings targets. And here's why, right? Because the approach, which is an asset allocation approach, says in order to meet your plan objectives, you need 1.5 million. You only have 1.2. You're just like 77% of the people. You're underfunded. So now you have these choices. But as of now, you're going to find out those aren't the only choices, right? The other consideration for the client is to say, wait a minute, what if you didn't have to delay retirement? What if you didn't have to save more money? What if you didn't have to take on more risk, right? What if you didn't have to roll the dice? What if simply by taking benefits at a different time, we could profoundly impact the amount of capital it's going to require for your plan to meet your objectives? Not my objectives, yours. 108,000 for 30 years with a 99% probability of success. Well, if I opt not to take benefits till 70, the income gap falls from 36,000 to 18,740. But then we have to adjust it for inflation, because the question isn't whether or not they're retiring at 67. That's a given. The question is, how much income are we going to need from assets when Social Security benefits begin? Well, 3 years from now, we're going to have to adjust that 18,740. The actual inflation adjusted gap when Social Security benefits begin would be 20,515. This is what we need to be able to provide out of the assets. The initial safe withdrawal rate is 2.62 net, because we're 3 years into the 30-year time horizon. The capital requirement now is 730. So clearly, we're moving in the right direction, closer to the budget that they have, the budget being the amount of capital they've accumulated. But if we're going to have them retire at 67 and simply wait till 70 to take benefits, we've got to understand what's going to happen during this period of time, which we call the bridge period. So how am I going to survive? How am I going to meet my $108,000 a year income need on an inflation-adjusted basis between 67 and 70? Well, worst case scenario, you're going to fully self-fund. If you need every penny of that income, you never work another day, and we deliver $108,000 a year, inflated by 3.1% for 3 years. We're going to need $334,148 to fund that income the first 3 years, right? Then the Social Security kicks in. We established a permanent gap, which is 20,515. We need 783 to close the permanent gap. When we add the 783 to the 334, we need bridge capital for this bridge period. Total capital requirement, 1.1 million. So to be clear, we took the same income goal, the same time horizon, the same inflation assumption, the same portfolio construct, the same desired probability of success, the same primary insurance amounts. Everything is exactly the same. The only difference between these two scenarios is in the earlies we took benefits at 67, in the laters we took benefits at 70, and I would argue the impact is profound. They go from underfunded by $300,000 to slightly overfunded, right? And it didn't, again, require them to get lucky. They didn't have to delay, didn't have to pick the right stocks, the right bonds, the right crypto. All we did is leverage one more tool in the toolbox instead of ignoring it, Social Security, and we completely changed the outcome for them. Now, if I stop there, I would argue this is a pretty compelling story about why you need to consider the implications of Social Security in the broader retirement income plan. But I'm not going to stop there, because the story gets even better. By the time they're 70, whether they take benefits at 67 or they take benefits at 70, the inflation-adjusted income need, and the inflation assumption we're using is 3.1%, has grown to 118,358. Now, we know, based upon the DRCs, the laters are going to get 24% more than the earlies. So for the earlies, they have 118,000 in total income. We project Social Security will deliver just shy of 79. So they'll need another 39,452 now by the time they're 70 to meet their goal. Why not 36? Because of inflation, right? So that swelled to 39,452. Here's the part no one understands. Even though they have just shy of $79,000 in Social Security income, only $35,669 of it is considered taxable. That completely flies in the face of what people think they understand about the taxation of Social Security benefits. To understand their total taxable income for the earlies we take the taxable Social Security 35,669, add it to the fully tax invested IRA distribution from the 1.2 million, and we have $75,000 of taxable income on $118,000 of total income. What about the laters? Well, we only need $20,515 beginning at age 70 in fully tax invested distributions from the IRA to close the remaining income gap, and only $27,621 of the $97,843 in Social Security income is considered taxable. I want to say that again. Out of $97,843 in total Social Security income, only $27,621 of it is taxable. Add it to the $20,515 in a fully tax invested IRA distribution, the total taxable income is $48,136. Out of $118,358, $48,136 is considered taxable before deductions. Okay, so to be clear, not only have we built a plan that took them from underfunded to overfunded, but we're also going to deliver a plan that's significantly more tax efficient. How does that happen? Under the rules of provisional income, Social Security is taxed very differently than any other form of income people have. And until you begin collecting Social Security, you have no understanding of just how tax efficient it can become. But the bottom line here is that under the provisional income formula, 100% of your modified adjusted gross income is counted in determining your provisional income. So to be clear, your modified adjusted gross income is all your earned, unearned, and tax-free dividend income. And all of that is counted at 100%. So even tax-free dividend income, which isn't taxable, is countable at 100 cents on the dollar for determining your provisional income value. But how much of the Social Security benefit is counted? Only 50%. So this is where the magic happens. This is really stunning to most people because what they think they know is they think if I'm a married couple filing jointly and I have more than $32,000 of Social Security income, then 50% of my benefit is taxed. And if I have more than $44,000, 85% of my benefit is taxed. Well, that's not correct. Couple of things. Number one, you'll see the operative term here is up to 85 and up to 50, number one. But these thresholds are not applied to your total income. They're not applied to your Social Security income. They're applied to your provisional income, and your provisional income only counts Social Security at 50%. So let me walk you through really quickly how these numbers work. So I'm going to show you there's 3 tests the IRS uses. I'm going to use test 3. For the earlies, by the time they reach 70, this is what we project Social Security to provide. And we already said this is what they'll have in a fully tax-infested IRA distribution. Together, that gets them to the $118,000. Now, to determine provisional income, we take half the Social Security, all of the IRA distribution, we're at $79,805. To determine how much of their Social Security income is taxed, you take the provisional income formula, the provisional income value, you subtract the first threshold. Everything over the first threshold, you count at 50%. That's step 1. Step 2, you take that same provisional income value. Now you subtract that second threshold. Anything over that second threshold is counted at 35%. That's $12,216. Add those two together. That's how you get to the $35,669. Real quick, the reason we only need 35% in step 2 is because in step 1, we counted everything from the first threshold, $32,000, up to the provisional income number at 50%, right? That includes everything from $44,000 to $78,905. So everything from set 32 to 78,905 was counted at 50% in step 1. So to get to 85 and everything over 44,000, we simply need to pick up another 35%. Now, what about the laters? Same process, right? 97,843 in Social Security, 20,515 in IRA, half the Social Security, all the IRA. You've got a smaller provisional income value in spite of the fact that you have significantly more guaranteed income. Here's the math for you. First threshold, 50% of everything over that threshold. Second threshold, we're over by 25,437. 35%, add the two together, you're at 27,621. So to be clear, 24% more guaranteed income, 30% less taxable income. That's on top of the fact that we took them from underfunded to fully funded or just slightly overfunded. Now, here's the other thing that's really important. If I'm a married couple filing jointly for 2025, in 26, Standard deductions alone, if we're both over age 65, will be 46.7. So think about that for a minute. 46.7, it's a dollar for dollar reduction against the taxable income. You have a total taxable income if you're the laters, right? You remember what they had, 48,136, right? We're going to take away 46.7. Okay. So the bottom line is they're going to have about, I don't know, about $1,000, $1,400 in taxable income and a tax liability of about $10 a month. So on an income of almost $10,000 a month, they're going to have to give back about $10 a month in federal income tax liability. Most states don't tax Social Security. What's the point? We built a better, more fortified plan for less capital, and as an added benefit, not the feature, but as an added benefit, we effectively eliminated taxation. And we did it how? Simply by taking Social Security at a different time. Now, here are the numbers. Went from $300,000 underfunded to $82,000 overfunded. That's a $300 and call it $83,000 swing in your client's favor, which is great. But the real question is, could you make this plan better? And the answer is yes, you can make this plan better. And here's how. Instead of utilizing an asset allocation approach to deliver income, you went with an asset optimization approach. That's what we call using all the tools in the toolbox. You optimize all the assets. Social Security is an income asset. We just optimize that. What's the other tool that's in the toolbox that we've been ignoring that we can optimize? A fixed income annuity with a lifetime income benefit rider. Why? Because we can deliver to Athene $283,945 today in the Ascent Pro 10 and have it deliver the $20,515 on a contractually guaranteed basis for the duration of 2 lives, beginning at 70, and we're using the indexing feature so this income can combat inflation. So why do I bring this up? Here's what we need if we're using an asset allocation approach and take benefits at 70. Here's the bridge capital. Well, what if we wait till 70 to take benefits? We'd still have the bridge capital, but now instead of using an asset allocation approach, we used an asset optimization approach. Well, now we need $618,000 to do the same job. So to be clear, this is an $882,000 swing in your client's favor. Again, how did we get there? By embracing all the tools and leveraging all the tools in the toolbox, by optimizing not just what was in front of us, but also optimizing Social Security and the power of leverage we get from a guaranteed lifetime income benefit rider. It's a 50% reduction in the capital requirement, right? And we end up with almost $582,000 we can make the case for right now that we do not need to make that retirement income plan whole. So let's be clear. If I use an asset allocation approach to deliver income, here's what I can say. I cannot definitively tell you exactly how much capital it's actually going to require for this plan to be a success until the death of the second spouse. Everything right now is pure projection based upon what I understand to be historical data, right? But based upon what's happened historically, this is what I believe is possible. I don't know that it's highly probable, but I know it's possible. Under the optimized approach, not only can I tell you exactly how much capital we need to commit today to deliver the income plan that you want, but because I know exactly how much we have to commit today, I know exactly how much we have left to do better, more important planning for you and your family today while you're alive, when it's meaningful. So that's the power of asset optimization. And when you look at it from a plan perspective, I'll wrap it up right now. If you focus on what I call the 4 areas of concern, the areas that we know people are concerned about, and we compare the earliest plan, which is what most people are thinking about doing, to the optimized/latest plan, here's the outcome. The percentage of the income that's guaranteed, 67% versus 100%. Why? Because Social Security and the annuity delivering the income. The amount of income adjusted for inflation without market exposure, only that amount attributable to Social Security can say that on the early side. For the laters is 67 plus because we're using the earnings indexing on the Athena Ascent Pro 10. Income goal considered taxable before standard deductions, 61% versus 40%. Annual guaranteed survivor income minimum, this assumes no COLAs are ever declared on either the Social Security or the annuity, 38.4 versus 68.131. By the way, what would you have to have left in capital upon the death of the first spouse to deliver an extra $30,000 of guaranteed income? Again, I think you know the answer. Close it out. The only thing we ever run into when it comes to positioning annuities is this idea that they're not liquid. You know, when we talk to people about that stuff, we make it very simple. There's three buckets we want to think about when it comes to planning: the income bucket, the discretionary bucket, and the legacy bucket. Yes, if we go with an asset allocation approach, theoretically, the account is completely liquid. You can sell out at any time without a surrender charge. Of course, there's no floor. We have no idea what the losses could be on any given day. But ultimately, when people tell me that, what I say is, so what you're telling me is you're concerned about access, you're concerned about control, you're concerned about liquidity. They'll say yes, yes, and yes. That's exactly why you should consider the asset optimization approach, because under the asset allocation approach, while you may be theoretically liquid, it's only 75% of what you need. 1.2 million is only 75% of what you need. You have nothing left for discretionary spending, nothing left for legacy. So if you need more than your monthly check to cover your bills in any one month, you're going to just further destabilize an already highly unstable retirement income plan. Under our plan, we're going to commit 52% of the assets to the income plan, or $618,000. And that means we have $581,000, almost $582,000 we do something different with, right? But you can burn through $582,000 before you ever destabilize this fully funded, highly inflation adjusted, highly tax efficient plan. I would argue that this is far more liquid, gives you far more control, much more access using this type of an approach. At the end of the day, our argument is simple. If I've done my job during our workshops and you do your job, you understand now that whether or not you end up with enough money in retirement has far more to do with the approach the people you're working with take, and far less to do with how much you've saved. You've seen that firsthand here with the earlies versus the laters. We do it all by entering just a handful of inputs, 5 to 7 inputs into the retirement asset optimizer, and we can show in real time the impact of taking benefits at any time on the overall capital requirement. Here's a quick look at what the retirement asset optimizer looks like. Here's the plan comparison page, which kind of lays it all out. Eric calls this the money page. But what's the plan objectives? How long do you want it? A number of years? What's the probability of success? I'll bring your attention down here, right here, to the capital requirements. So these are the very same numbers we were just looking at. Now, the thing that I would implore you to think about is this. When it comes to building retirement income plans, we need to help people make sure, when I say people, retirees, that they're applying the right logic. If you apply a growth investor's logic to an income decision, you're going to make the wrong decision every single time. If you apply an income investor's logic, to an income investor's decision, you're going to make the right decision every single time. And here's what I mean. When you're growing money, the fixed portion of the equation is the amount of capital you invest on a quarterly or monthly or biweekly basis. The variable is what it earns. And the greater it'll earn, right, the more likely you are to invest. When it comes to income, the fixed part of the equation is what you're earning, what you're getting. So take a look at this part right here. No matter which way we go, take benefits early, later, or optimized, we're delivering that same $108,000 on an inflation-adjusted basis. The variable part of the equation when it comes to income planning is not the earnings itself, but the capital required to deliver those earnings. Well, under the current plan, what people historically do, we've already shown we need 1.5. The Lang drops it to 1.1. Our strategy requires 618,000. Think about it this way for a minute. Let's imagine somebody came to you and they said, hey, I've got 3 solutions for you that'll give you the exact income you're looking for in retirement, right? All 3 are rental properties. They're going to deliver the $108,000 you want on an inflation-adjusted basis. They've been fully capitalized. They're lifetime leases on the lives of 25-year-olds. You cannot lose. You can only win. The only difference between these 3 properties is the asking price. And the one on the left is on for $1.5 million. The one on the right's on for $1.1. One in the middle's on for $1.1. The one on the right's on for $618,000. Which property, assuming you agree this is the right approach to get my $108,000, which property would you have me buy for you? It's a no-brainer when you think about it the right way. So Eric, you're back, which means I'm done. Hopefully, I've opened some eyes, and I'm happy to answer any questions. Look forward to doing something more with this group if they like what they saw today.
Absolutely. Thank you so much, Andy. And yes, my eyes are always wide open when you're presenting. Folks, Andy did a great job of giving us a summary here at the end, but I'm going to try to put a bow on it. These folks retired at the same time with the level of income they wanted. They made no changes to their plans. Let me be clear. The only difference is they achieved their hopes, goals, and dreams in retirement for $800 and some odd thousand less than it would have cost had they embarked upon the plan that they initially had in mind. That is really, really powerful. And so, what Andy and his team have done has created this entire process that ultimately results in this dynamic software that can help you walk a client through and help them really see the light. We're not telling people they can't retire the way they want to retire without the income that they want to have. But what Andy and DMI are partnering to do is to help you get the client to understand there's a better way. And that's what this is all about. So it's powerful. And yes, Andy, I do refer to this as the money page. This is the page that absolutely motivates clients to action. Folks, I've seen it in real life. I've seen the reports. I've seen them delivered to clients. I've seen prospects become clients simply because of this software. And it results in stronger retirements and a lot more business for the advisors that embrace this strategy. So, Glenn, Andy, Maureen, back to you.
Hey, you know what? I'm going to pull up Eric's information here. What I'd offer to everyone, hopefully you're okay with this, Eric, is to give Eric a call and run some numbers by him. Let him run it through the RAO software and see what the numbers look like. And then, talk to him more about how you can apply this to your business. Get certified, then get access to the RAO, learn how to use it yourself. And to start off, to get things rolling, we do have a CSSCS class on November 11th and the 14th. So we do the training and the test on the 11th, and then the RAO, like a 1 hour RAO training on the 14th. So put that in your sights. You want to get the book beforehand and study and that kind of thing. But it's really a game changer. So I'm going to share Eric's contact information here. Use that QR code, just scan that, and that'll get you all of Eric's contact information. Or if you just want to put his phone number into your phone there, 781-919-2351, or email him at elandewall@dmi.com. But Andy, thanks again. That was fantastic. And Eric, thanks for the help. Maureen, thank you. Everybody, thanks for attending. Again, please reach out to Eric with any questions around this. He's happy to help. And then once we get you on track with CSSCS, Andy is going to be there to support you personally as well. So thanks again, everybody. I think that concludes everything, unless I missed anything.
We're good.
Good. Thanks, everybody. Have a great day.
Call me.
Thanks so much. Thanks for attending today, guys.